We talked a little bit, my colleagues here at Asset Strategy and I talked a little bit about 1031 exchanges and Delaware statutory trusts and opportunity zones, qualified opportunity funds, and so forth this morning. We touched on some of that. What RCX does, and I'll let its principals speak for themselves, but I'm happy to be joined by Jean-Louis, as well as Paul, Jean-Louis Guinchard and Paul Grumman, and hopefully I did not mangle either name. What they do really builds upon the discussion of this morning and actually really lends itself to a family office type of environment. Again, typically in the sort of life cycle of an offering under Reg D, you've got a sponsor who syndicates various programs and offerings and so forth, and then you've got this broker dealer network, independent broker dealers and managing broker dealers and arrangements and registered representatives and so forth. What RCX does, and what these two gentlemen, who are a lot smarter than I am, do is sort of embraces every element of that life cycle, compresses it into one, and does fantastic things with it. They create, structure, add, subtract, strip, and make a lean, mean fighting machine out of 1031 compliant and ozone compliant real estate. And with that, let me flip to Jean-Louis, I think, first, and have you guys talk a little bit about who you are, who RCX is, and what you do and what it does.
Great. Well, thanks so much, Michael, and really appreciate you inviting us to participate in this forum. And you're way too kind. And following SPACs and VC at this time of the day is always a little bit challenging because, in fact, you're coming about being smarter. Not so sure that's the case because you left me behind at SPACs. So anyway, yeah, RCX Capital Group. I'm Jean-Louis Guinchard. I'm the founder, one of the principals of the group. Paul is one of our partners and joined us a couple of years ago, and I'll let him talk about his background. But RCX Capital Group really does three things. Well, two things. One, we have been for the most part a capital raising platform. We're an investment and merchant bank. Most of us came from Wall Street. I was at Salomon Brothers and Goldman Sachs. I was also part of the team that bought Bank of America. So we've been very, very active in a lot of different asset classes, but decided back in 2000 and pretty much 4 or 5 to focus exclusively on real estate. In our what I'd say our capital raising platform, we match very high quality real estate sponsors to investors, and those are institutional investors, family office investors, RA investors, and direct investors. And then one of the companies that we'd actually raised quite a bit of capital for in the past was a group called Inland. Inland is one of the largest private real estate companies in the United States, and they happen to have a very, very large 1031/DST business that, candidly, we hadn't been involved in whatsoever. We spent a lot of time with them, ultimately got to know them really well. They happen to be the largest sponsor of Delaware statutory trusts in the country, which you guys talked about this morning. And we ended up doing a couple of very large transactions, but because of the opportunity that we saw and we would probably say the opaqueness of that, that market, we thought there was a huge opportunity of such a massive amount of individuals that were, literally getting older. A lot of the wealth that was tied up in real estate has to be transferred over to, the next generation, and how do you do it efficiently? And then, as you guys discussed this morning in 1031s, real estate is one of the only asset classes that that actually you can do that very efficiently. And take advantage of incredibly favorable tax deferral laws. So we built a practice around that. I'll get into a little bit more detail, but effectively in what we call our tax advantage platform, precisely as you say, we work with and partner with great fiduciaries like Asset Strategy and other really good firms like Clifton Larson Allen BDO and others that have very large, what we believe, truly objective platforms that really try to give their clients good advice. We work with a lot of multifamily family offices and help them essentially, and help your clients make better real estate decisions, on the back end of, when they're selling highly appreciated real estate. And so that's what we do in RCX. And then we happen to also, the relationship with Inland really got pretty strong. My partners in Mexico are also the largest affordable entry housing developers in the country. And we also formed a family office, which is called Insania Wealth. So we understand family offices, work very closely with family offices, and we do a lot of our principal investing in the space. And last thing that I'll end up just saying right now about the group is, we raised something north of, between our principals and ourselves, well north of 100 billion of capital. Inland, we'll talk about that a little bit more later, about 80+ billion of capital and programs, and work very, very closely with a number of different sponsors, which we'll talk about. But Paul?
Yeah, I'll be very brief. I've spent my entire career in capital raising, focusing on basic retail distribution, and within that retail distribution umbrella, I've been focusing on IBDs, BDs, RAs, and ultimately my final leg of that journey. So that's the better part of the last decade. My final leg of that journey, I was running kind of the account team and assisting in the overall distribution efforts for Colony Capital. And ultimately, I was literally 1 foot out the door. I was getting out of product distribution, and I was looking at different paths of my career to see where I could go, and met with JL. And everything that RCX Capital is doing was exactly what I wanted to do before I joined RCX Capital Group. And what I had found is, I was running into a lot of obstacles with technology platforms, with product, and then getting access to end investors. And ultimately working for one product sponsor, I felt like I was limited and wasn't always able to get the best product into actual investors' hands. And so with RCX business model, it enables us to stay very product agnostic and solution agnostic for that matter, and really provide a consultative fiduciary approach to working with clients when they're trying to make decisions around their real estate and their investment real estate. And I really, this consultative approach, I think, works really well, specifically in the markets that I was working in prior, in the RIA market, right? So all interests are aligned. So it's been refreshing to be able to have some optionality and really true custom approaches and really true solutions for clients that have real estate needs. And so that's why I'm here. And that's a little bit about RCX, right? I think you're on mute, Michael.
Yeah. Still on mute, Michael.
No, I think am I good?
You're good now.
There you go.
Okay, sorry about that. I don't usually do that, but oftentimes when I'm on mute, I'm told sometimes there's a benefit there as well. So anyway, Paul, I just wanted to pick up on the last thing that you said regarding sort of the fiduciary consultative nature. And I think hopefully if everybody was paying attention to our presentation this morning, there are, some chords that are, identical and some ethos that is common, a lot of commonality between sort of the RCX approach and what we do here at Asset Strategy. I guess in summarizing that in just a phrase or a sentence, nobody at RCX, and I would say nobody here at Asset Strategy, is ever trying to sell somebody a product. Instead, we sort of embrace the idea of being receptive to understanding the stories behind the clients and behind the folks that we meet with, in terms of trying to be good problem solvers without embracing a particular product or approach or what have you. And again, I think that's what I'm hearing from Paul and what I've observed, through RCX. That sounds very common. I wonder if I might pivot a little bit and talk not just about your approach generally to your clients, but your approach when it comes to due diligence, your approach when it comes to vetting product, in terms of how do you guys make the magic happen and ensure that in coming up and deriving solutions for your clients' issues, problems, whatever, that you're coming up with a range of options that are secure, that are that are designed to succeed, et cetera. And with that, I'll go back on mute.
Sure, and great question. Well, that approach you hit right on the nose. For us is,
before you get going, sorry to interrupt. I want to say one thing because I forgot. This is another reason why I came to RCX is that I found the diligence and the third-party diligence providers, there was always some inherent conflict of interest, and that the sponsors were actually paying for the diligence services. And then the diligence that was done, you couldn't always provide that to the end user investor. So it's a real challenge, right? And I think, with what we do, you'll learn about our approach. We put that and we put our diligence right alongside kind of our potential solution suggestions with our clients and really stand behind our work, which I like, so go ahead, JL.
Well, you definitely was going to touch upon that. So precisely to your point, what this is about is when anybody's selling a large piece of property, what we found, and part of the challenge of building sort of our platform and scaling it the way we have has been sort of what I would call sort of mass customization, if you will, right? So how do you really do the things in terms of being able to educate individuals? How do you be able to get access to sort of best-in-class sponsors? How do you be able to underwrite that efficiently to really try to bring the cost structure and the education level to a very, very different level, right? And so, much more effective, much more aligned with investors and the like. So for us, in virtually every single asset class that we invest in, but certainly in the case of all of the real estate, both in Delaware Statutory Trust and op zones, it all starts with the sponsors, right? So we do, to your point, Michael, very similar to what anyone would do with a traditional fund sponsor. These are not fund sponsors because funds do not qualify for 1031 exchanges, as you know, but these are sponsors of, in essence, tax advantage programs, and we do an exhaustive amount of due diligence on those for every single aspect, very similar to what we do on an institutional caliber, what we've done in our, forever. And that is everything from, getting very comprehensive DQ, getting going through the entirety of the operations, the protocols, procedures, everything that this organization does, meaning every single member of the team understands sort of team attribution. That underwriting is pretty important to us. And more importantly, as Paul suggested, is we share that information with our partner, like, asset strategy, real time. This is, we try to keep that very, very objective. Love the previous conversation that they were talking about using AI for valuation and using different aspects. Those are things that we're looking into in terms of how do we really get to what we would consider to be truly objective underwriting, remove our own personal biases, and really get to the point where we can understand, the specific attributes of markets, the supply-demand characteristics, everything associated with a particular team, property, and location, and so forth, and try to be as transparent in that process as possible. So we're not shy of doing that. In fact, even in the case of Denlin, who owns a stake in our platform, they are the largest sponsor of DSTs in the country. I would say we approved probably 6 of every 10 transactions of theirs. So, and even to that point, what we found, Michael, as you guys well know, is that when I think there's something like 40 sponsors today, and that are currently, and this is just in the DST space, in the qualified opportunity zone space. Everyone and their mother who's a developer is trying to be in the QOZ space. So that's a very, very different number and type of platform and offering. But with regards to DSTs, about 40 sponsors, right? Of those 40 sponsors, when we started underwriting, we've underwritten probably 16 or 17 of them in depth, very time through the process. We could only really get comfortable with 3 or 4 of those guys. So it's once you start getting off the first 2, 3, the quality tends to drop off pretty significantly. So much so where we found ourselves as we were looking to scale the business that we had to partner with best-in-class operators that we had the privilege of working with or having raised a lot of capital with in the past, and in fact, convincing new sponsors to come into the space. So the good news there is that I think as DSTs have gotten more popular, as firms like BlackRock are coming into the space for 721 programs, JLL is doing a 721 program, which is a slight variation. It's not a Delaware Statutory Trust, but it's an UPREIT type structure. you're starting to see, in our opinion, a true institutionalization of the asset class, right? Which is what we really like and what the market really needs, because the needs are off the charts. So we're excited about that. We've had the great fortune to partner with firms like that we've invited in to help us develop product like Murry Global Asset, 450 billion AUM platform, where we did an Amazon facility recently in Macon, Georgia, where we partnered with them to really create, once again, best in class structure with much lower and much more aligned fees. I think our fee structure on that was probably 30% of traditional fee structures, and as well as higher cash on cash returns for investors. So when you actually look at and you go through, a lot of this product, as you know, Michael, had been reverse engineered, right? So it really is reverse engineered to generate a specific cash on cash return. That's still very much
structured finance is the start instead of the real estate itself, right?
That's exactly right. So irrespective of the leverage, the asset class, you would typically see a cash on cash return that was sort of in the same ballpark. Most individuals are really in it for the tax deferral, which is anywhere from, say, 25 to 35%, of potential deferral, plus a good 5 to 5.5, 6% cash on cash return, as well as sort of modest appreciation on the programs. What we said is and what we do in our capital raising business is, how do we really let the market drive the pricing, right? And how do you get the cash on cash return? I can tell you that we're not there yet because the market's not there yet, but that's where the puck is headed, and that's where we're heading.
Well, one of the things, Paul, that I picked up on from JL's comments was that despite the fact that RCX Capital acts in an agency role much of the time, it really conducts its business as if it's acting in a principal role. And I wonder if you could speak to that, sort of relative to your process and, how you do asset allocation, and how when you're sitting down with a family office or a high net worth or ultra high net worth client, and there's $100 million plus disposition on a tax deferred basis, how do you approach it? How do you approach it from a diversification, asset allocation, tax, and other perspective? And again, I'm sort of the theme that seems to keep reappearing with RCX is, again, in many cases we act as principal, in many cases we act as agent, but when we act as agent, oftentimes we have the mindset of acting as a principal, and I love that. So I wonder if you might be able to speak to that.
Yeah, I don't know, JL, I know you put together some slides that maybe you can walk through, but I don't know if that's really at the fingertips, but essentially, before we even start anything, right, we always have a thorough conversation with both the advisor and the investor. And we really learn what the objectives are that they're trying to accomplish. We learn about who the stakeholders are in that actual process. It's not uncommon when you're looking at some of these larger deals that you'll have several family members involved, and have opinions, if you will, and may have different objectives, right, than other family members. So it's kind of a fiduciary consulting type relationship, and really getting down to the bottom of the best solution for all parties involved, right? And it seems like the bigger the deal, the more complicated it gets. And so drawing from a lot of JL's experience in investment banking, he's worked on a lot of these deals in the past, and a couple of our other team members, April as well. We listen, take notes, evaluate the market, provide 3 or 4 allocation scenarios, walk through them in granular detail, see if they're going to meet the objectives, refine, tweak as many times as we need to, until we ultimately get to an allocation model that meets the objectives of all the constituents involved in the transaction. Sometimes that involves reaching out to our partners within the market to build out custom 1031 exchange solutions, which we've done several times. And then sometimes it's just evaluating what we currently have and taking different tools within each of these product solutions, working and putting them together to find that solution that meets all the objectives. I don't
Yeah,
know if
no,
there's anything you'd like to add to that.
Yeah, I'll add just a couple of quick things on that, Paul, and thanks. The 1031 and working with a family, particularly sort of the bigger the transaction, the more potentially complex. But the earlier one gets involved in the planning of it, the better, and working with who we consider to be real trusted, advisors and objective advisors that aren't looking to direct. It has to be part of it, because if not, the outcome isn't great. But a 1031 and a sale and the replacement property is sort of like trying to align the planets, right? So you're dealing with a lot of things at one point in time. What's available at the time? When are you going to be selling? How are you going to close? What is the leverage, et cetera, et cetera. So ultimately, this is really driven by what are the investor and the family's objectives as they transfer sort of this property? What is their estate planning needs? What is their how much liquidity do they need? And you try to hit as many of those possibly within the constraints that the group actually has. Having said that, a DST may be a good solution. It may be a terrible solution, right? And so in many cases, that might not be a great solution. A qualified opportunity zone may be better. Many real estate investors also want a lot of their liquidity up front, right? So we are looking at different structures there that, once again, we tend to be pretty conservative in terms of, aggressive tax structures. We're not tax advisors, but that's why we like to partner with different groups that are much more versed on the tax side than we are. But, some cash out type structures where people can invest in long-term, very high quality, high credit tenant, projects and properties. And then ultimately, take out some of the, the capital, right? Or in the case of a QOZ, as you guys, I'm sure, discussed this morning, where you're not investing 100% of the principal plus the basis, or the gain plus the basis. You're only reinvesting sort of the gain, right? So you have the use of your principal, for the period of time, for that investment. So, but the key for us had been and is always, Michael, the biggest issue is that we believe fundamentally in sponsor diversification, tenant diversification, geographic diversity, asset class diversification, and candidly, that has performed remarkably well in this. And then also in this, sort of COVID environment, right? And in that, you have to be far ahead, because these are long dated investments. So we have the great fortune, when you work with great sponsors, to also start thinking very, very seriously about what are the future asset classes that will perform well, right, over time. So we were very lucky to basically start getting out of retail early on, really focusing on necessity-based retail, focusing on industrial, putting together some very excellent thing. Big portion of the portfolio is allocated to what we would consider to be affordable, garden style, multifamily, class A, class B plus, A minus at worst case. So this is, core quality that has actually, withstood that test very well through this environment.
I think, JL, that's a great segue to sort of the next the next line of inquiry here. I believe you have partnered with Murry, and not just on a one-off basis, but regularly. I wonder if you might be able to talk about that relationship generally, who Murry is for those that don't know, and perhaps use the Amazon facility as well as the custom DST in Phoenix as just case studies, if you will, of and this is open to both Paul and JL, and you guys can divide and conquer however you wish. But I thought those would be two good real world examples for the audience to understand exactly the level of sophistication and the process.
Sure, I'll start, Paul, and let you kick in here, because Paul's been intimately involved in all that we do with the group. And for those of you that don't know Murry, world-class organization, probably in our opinion, and we've been doing this for a long, long time, probably one of the single best real estate portfolios that we've ever seen. Amazon headquarters, some of the top Four Seasons hotels around the world, truly world-class, class A assets, no matter where they're located. 450+ billion in assets, one of the most impeccable balance sheets that we've seen, a South Korean conglomerate. And the group that they have here, the real estate group in the US, which works very closely with the South Korean group, is actually based in New York and run by a fellow by the name of Tom Park, who's just incredible, just very accessible and great, and a small team. Several other people came from some of the best performing funds like CIM and other groups that we know very well. So and very approachable, very good. And when we had the fortunate opportunity to be able to work with them, we had suggested that the biggest issue about this is you have to have a strong balance sheet to be able to take these deals down, right? Because these are not, you don't wait to syndicate the deal, right? Because people are doing 1031, you have to take 100% down, right? And if you have a good balance sheet, you have the ability to buy better assets, and then you basically also have a seat at the table when 3,000 people are competing for that same asset, right? So, and this is, as you guys know, there's been a flight to quality, and this has been one of those markets where having them as a partner has just been sensational. But having said that, also very, very disciplined, and not, we literally were just about to acquire another Amazon facility, not in Washington, D.C. Unfortunately, that fell apart. We just couldn't get comfortable on the due diligence side. So, just people that won't deviate from the same type of standards, which occasionally is tough, because their standards are so ridiculously high, but we love that, right? So, anyway, what we did is we asked them, as we said, as Paul had alluded to before, a lot of the market was really geared towards sort of higher fees, lower cash on cash return, and those fees range from acquisition fees, property management fees, asset management fees, distribution fees, et cetera, et cetera. A lot of those are actually germane to any real estate that you buy, right? And a lot of those, we verified that those are things. But when it comes time to some of the key stuff, what we view is that, where the market is actually headed, as I said earlier, is how do you really deliver better quality product with a lower sort of fee structure? And that we, as Paul will probably tell you, we probably pushed it a little bit too far on that end. But from a practical perspective, we think that was, so we had the great fortune of putting together an Amazon. It's the highest, it's already sold out. Unfortunately, this is a brand new build-to-suit facility, 15+ year lease. Higher cash on cash return and Amazon quality credit, 6% cash on cash plus 1.75% rental escalation a year with about 50% leverage, right? With a shorter duration. And it looks like Marty is about to tell us to move on. So I'll keep my comments brief on that.
A couple more minutes.
Okay. So Paul, anything you care to add to that?
No, and I think the only thing I would add is that the discipline is critical. And when you start really getting involved with the biggest and best sponsors that are out there, it's a small world, and there's just not a lot of great opportunities in the marketplace. And in fact, we've seen now that some of the sponsors that we're in active communication with, not all that we're working with, they're in on some of the same deals as other sponsors, right? And that just kind of shows you how competitive the market is. And the one thing about Murray that's great is you see them backing out of those deals, because the pricing just gets too hot, right? And you can't just the risk doesn't justify the returns, et cetera. So when you partner with a company like that, it's just really great to see that discipline, and to the detriment of them, right, and us not having forcing purchases. You don't always have product in the market, but when you do have product in the market, you're pretty much almost guaranteed it's going to be the best, if not one of the best, in the market that's available to investors, which is always great feeling.
And one last thing that I'll add, because I know we'll probably have to go here, but our whole model was really built on how do we decrease risk, right? How do we really bring that risk down? So better the quality of the sponsor, lower the risk. So the partnership with groups like Asset Strategy, lower the risk in terms of suitability, know your customer. How do we do an exhaustive amount of due diligence and underwriting, brings down the risk. So how do you really take that, because these are long dated investments, and obviously real estate is pretty volatile. But anyway, thanks, Michael. And looks like Marty, I think our time is running out.
No, Michael, if you have a question or two more.
Oh, okay.
Absolutely. One more question for you guys, and it's somewhat unique. You within your platform both own and house a family office, and you actually work for family offices, single family offices, multi-family offices, et cetera. Within the framework of the family office environment, which is one of the reasons we're all here today, in terms of what you all do, and Paul touched on this a little bit earlier in terms of different members of a family having different agendas and so forth. What do you see at this point in time, this unique point in time, relative to to tax deferred real estate, op zones and DSTs and so forth? what do you see as the biggest challenges of serving your own family office as well as, you know, other family offices who seek your counsel?
You know, that's a great question. And well, you get to see a little bit of everything, right? So in our particular case, we are a family office, and you know, we're very involved in tax advantage real estate, so we can take advantage of everything that has to offer, which is unique in virtually any asset class, right? So you know, the type of returns that you can generate, the what we would call the adjusted risk, you know, the adjusted risk of sort of the type of portfolio that you're putting together here, as you know, relative to the return that you're getting, is just, we just don't see that anywhere in the market. That number one. Number two, family offices tend to own, you know, the wealthier you are, the more of alternative assets and real estate you own, right? So, and typically sometimes more complicated transferring that over to the next generation, particularly if you have, you know, you're already on the second generation or third generation. So, you know, these structures are great. But the biggest issue, in our opinion, is making sure you get good objective advice, number one, and plan early, right? As early as you possibly can. And then the third thing is, you know, a lot of family offices that we work with tend to have individuals that used to be the former the CFO of the platform that really know nothing about these structures, right? So oftentimes tend to steer them, you know, a different path without really understanding all that's available to them. So, you know, good planning will save you a substantial amount of money and give you spectacular returns, in our opinion.
Okay.
Fantastic job, guys.
Thank you.
So